You know, that was quite an introduction. I hope I can live up to it. And I really appreciate everybody for giving me some time here on their Tuesday evening. I know it's been probably a long day for almost all of us. Just a little bit about myself. I'm a graduate of the University of Pennsylvania and a former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years and began trading the futures and forex markets about 10 years ago. And really what we base our entire platform is on the optimization of software systems, all via the use of mathematical modeling. Every single feature that we put into our platform, we have back-tested and determined increases the positive predictive value of our trading. If it doesn't, then we eliminate it as a trading component or a component of our trading methodology. Now we can be found at Rightline Trading, www.rightlinetrading.com. Now, I want to go right to the charts. So I don't want to bore you with trading off the slides. And I may have to reshoot the chart. Just give me one sec. Okay. Now, first of all, I want you to take a look at this chart, and I want to really familiarize yourself with the Rightline trading system. Now, one of the hallmarks of the things that we do is that we trade with the fractal analysis. We believe that you must analyze almost every single piece of data that you have on your trading chart on multiple time frames. That analyzing data from one time frame is never going to get you where you need to be. And in this regard, what we have added to the platform since the last time we made a presentation on Online Trader Central is what we call background bias. A background bias to the downside occurs in three different colors, three different shades of pink. There's dark pink, there's light pink, and then if I can find it, there's sort of this tan color. Now, this is a very, very unique indicator because nothing that takes place, it does not analyze any price action or data from the actual trading chart. And we have developed a couple of indicators that do that, so that the price that you see being traced out while a color is present in the background. In other words, price action doesn't drive the color. The color is driving price action because this background color is not being determined by any candle on the chart. And this is our strongest down bias. It's analyzing data from the, we're on an 8 range. It's analyzing data from the 13 and 21 range. It tells us that market structure and price action are to the downside. Our 50 simple moving average is to the downside. Our right line trend is to the downside, and price action and market structure are to the downside. This is when we're going to get our strongest periods of movement to the downside. Conversely, when we get these, I'm just going to look for a big, obviously crude's been falling lately, and I'm using the crude chart here. This green. Green is when price action and market structure are moving to the upside. All resistance to the upside is broken, and the 50 and the modified 15 are moving up on our higher time frames. And you can see that the shorter time frame moves into the multi-analysis of the of the higher time frames. So what this has done is increase the predictive value of taking a long trade when the background bias is green. And for example, just right here, if we look at this move to the upside, excuse me here. And this retracement, right back to support, the chances that we're going to get a nice move to the upside is enhanced significantly simply by the one fact alone that we're working with background bias that's green. Same thing to the downside. When we get a break to the downside, retracement back to resistance, and then a confirmation candle that closes, the probability that we're going to get a move to the downside is strengthened by the fact that background bias is this dark color pink. And you can see every time we get a retracement back to resistance, we get a move down. And in addition, what we use to define market structure is the 50-period moving average. This is a simple moving average, and this is a proprietary trend line. It's a 15-period moving average, but does not move like the 15 simple or the 15 exponential. Now, what we've done, just after a lot of time, a lot of chart time, is we found that how important it is to be able to exploit periods of consolidation. So what we did was we created a consolidation indicator. Now, I want to find a really great example of consolidation. You can see the consolidation indicator. These create these channels in real time. These are not done retrospectively or printed on the chart after the fact. And there are actually really good trading opportunities here, but I want to kind of show you a stellar example. And here's a good one of how consolidation can be exploited to your advantage. Now, we know that we're in an uptrend right here. Now remember, we are devout trend traders. We never counter trend trade. When we're above the 50, we always go long, or we don't trade. When we're below the 50, we always go short or we don't trade. And optimally, we want to take a trade when the 50 and the modified 15 are above in green, or the 50 and the modified 15 are below and they're red. So a great way to trade, and really after spending a lot of chart time, this is something we just noticed, is when the market starts moving sideways, like this, when it starts to consolidate. Now you can vary the size of the channel. We have it set at 13 ticks, which we believe is the optimal channel size that you want. Now I just added these blue just to highlight it, but this is really all you need right here. And this is a pattern that's going to recur over and over again throughout the course of the day. You're going to see it keep recurring. Now the market is moving to the upside, and by the time we get here, we're in a confirmed uptrade on our trading chart. Oops, I'm sorry. And the reason I'm doing this is I don't want to trade off, I don't want to teach you off of slides. I see too many presentations where you sit for 45 minutes watching slides, then the last 8 minutes of the presentation, you actually go to the trading charts and learn how to trade the system. I'm sure everybody in this room is well past the slide stage and is into the practical application of what we do in trading. And that's why I'm just moving directly to the charts. Now, everything that we have, you have to take at the appropriate spot. When you get a period of consolidation here. Now, obviously, in terms of price action, the bulls are in control. Then price gets pushed down, and the bears are in control. In this channel, both the power of the bulls and the bears are equal. Their pull is pushing up, they're pushing down. Down, up, down, up. And what we see over and over again is that price channels right into support to the upside or resistance to the downside, and then once it hits a channel in a confirmed uptrend, the trend continues. And the longer the channel, the more powerful the blast out to the upside. So take it just based on what you see on the chart right now, without any more, and we're going to add a much more additional data. But just looking at market structure and looking at price action, taking this candle to the upside, based upon the consolidation indicator, is a really, really powerful trade. The thing that you must do is you must be in a confirmed uptrend to take a trade out off the support to the upside, or you must be in a confirmed downtrend to take a trade out of consolidation to the downside. And let's find another one. Here's another trade. And you're going to see these happen over and over and over again. Here's a trade to the downside. Now, we don't have background bias, but we have the 50 down and we have the 15 down. We're in a confirmed downtrend and we're consolidating. We get a move to the downside, we get retracement, but we're in a period of sideways movement. The market is going to break down to the downside. You're in one tick below the close of this candle, and you have a nice move to the downside. Here, the market is way oversold, and your anticipation is that this channel or this period of consolidation is going to end with a move to the upside. Here's another channel right here, and it hits right up against the 15, and up you go. Here's another one. Right here. Now here the 50 is yellow, but that's okay. That's only a matter of 1 degree between yellow and green. And the channel takes you right to the upside. So trading out of periods of consolidation in a confirmed trend where you're not overbought or you're not oversold is a very, very effective method for creating multiple wins in the course of a day. Later, I'm going to take you to our trading chart. In fact, I can't do it right now. I'll take you to the trading chart later. I had a 40-Fortner yesterday in the trading room right out of a channel on gold that just shot up 44 straight ticks. Obviously, you have to be very circumspect about where you trade, and you must confirm that you're in a downtrend or an uptrend, which on this software is extremely easy. You look right here. Every time the candle comes right into resistance to the downside in a channel, down you go. Here you're oversold, way oversold, and we have ways of defining oversold or overbought. When this breaks out of the channel, we know it's going to break to the downside. Only we don't have a trade because we do not trade the we call this modified 15 when it's yellow. Here's the trend trade. Down, down, sideways movement right into resistance. You're in 1 tick below the close and the move to the downside. And that's a trade purely off of market structure. There's no indicator confirmation here. Nothing else is going on. And you know with background bias, you have market structure, price action, and the 15 and the 50 to the downside of multiple time frames. So you know that you are in, excuse me just for 1 second. Leo, I hate this. Robert. Yeah, I'm sorry. Now I want to add one other indicator. And this is really one of the newest indicators, and it's sort of groundbreaking. And I hate to use that word, but you're not going to. The science of quantitative analysis is very, very new. I'm sorry. Here's what I want to do. I want to change this to a 5 range. And I want to move this to the ES. Okay. Now I want to show you what this line does. What these two lines do are they analyze the market direction from 5 other markets. So what we not only believe, what we've come to see, that the market's a really rugged place, and that trading over the course of the last couple of years, in my opinion, has gotten tougher and tougher. So not only do you need to assess market structure, price action, support and resistance for multiple time frames, but you'll also need to assess markets that we have determined via backtesting have a correlation coefficient of 0.7 or greater, in this case with the ES. So the markets that comprise these two lines are all markets that move in the same direction as the ES, either 70% of the time or greater. The ones that move in the same direction as the ES 90% of the time or greater are given heavier weight. The ones that move in the direction of the ES 70% of the time are given less weight. If they move in the same direction as the ES less than 70% of the time, they're not included in what we call our quant analysis indicator. So when you trade in the direction, in a certain direction on the ES, not only do you want to trade into a multi-time frame indicator that tells you that in this case you've got the 50 and the 15 down on multiple time frames. You've broken all support to the downside. In this particular case, you have the quant analysis indicator. You go right down here. And because the color that you're going to see in real time is just to the left of the arrow. And it tells you that all 5 markets, now some of these markets move in the exact opposite direction of the ES. But that's still a correlation coefficient because they correlate. Like markets like bonds and notes very commonly move in the exact opposite direction. So when you take this short trade after a break and retracement, you not only know here that you're trading, again, this is all market structure, because this is all just simply based on direction. It's an indicator, but not an indicator in the traditional sense of the word. Because all we're doing now is analyzing market structure and price action, not only on multiple time frames, but now we're doing it on multiple markets. So that the likelihood that this trade or the entry one tick below the close of this candle is not going to be successful, the positive predictive value of this short trade is amazingly high. And if you look here, you get a further move down. If you're stopped out, you get a retracement. And in real time, if you look down, you'd see that the quant analysis indicator, our lower line is red, our upper line is neutral, and that's enough to give you a short trade. Optimally, you'd like both lines to be red, but as long as one of them are red and one of them are neutral, you're okay. You just don't want any of these markets moving against you on the trade. And I want to show you an example of how this can keep you out of taking a bad trade that just is not going to go. And let's see if I have an example here. Here's an example right here. We have the move down, we have the retracement, and then we have every expectation here. The 50s, yellow and rolling. The modified 15 is down. You've got a nice retracement tight to the 15. Background bias is pink, which tells you that there's no areas of resistance to the downside. Market structure and price action are heading down. And you have every expectation that your entry here is going to give you a continuation short. But if you look at the quant indicator, none of the markets that have a correlation coefficient of 0.7 or greater are moving down. They're all moving sideways. You stay off the trade and you don't take it. Then you wait. You get a move down. You get the retracement. Here, drag this down. Now the quant indicator is telling you that quantitative analysis of multiple markets that correlate highly with the direction of the ES are all pressing down. And what do we get? We get a move to the downside. And this is really, again, I don't like to speak in hyperbole, but it really, really is a revolutionary indicator. You don't see indicators like this. Now, we've created one for the ES. We're working on one for crude oil. We've got one for bonds that we're soon to be releasing. And what we found after a year of market analysis is this dramatically improves the predictive value of an entry. Now take this move to the downside here. You have light pink, so you're okay to go short. You get a retracement. Now at the time that you take the short trade, the 50's rolling, but it's not quite red. You might be hesitant to take the trade, but look down at the quant indicator. 5 markets are rolling in the direction you need them to roll to take the ES down with you, and down it goes. So this is extremely powerful predictive indicator to add to the predictive value of a continuation short or a continuation long trade. And I mean, again, I don't want to beat this indicator to death, but you're going to see this over and over again. And it oftentimes, what seems to make sense intuitively doesn't necessarily get borne out in real life. I mean, for instance, we used to think the world was flat, and intuitively it sure looked like it was, but that turned out to be untrue. But if we look at this trade, look at this continuation trade. Now, there's no way this is not going to work. You've got all 5 markets, both lines, heading down in your direction. And remember, we're looking at 3 markets, the Dow, the NASDAQ, and the Russell, in which there's a lot of overlap of stocks. I mean, the stocks on the S&P and Russell and NASDAQ overlap. And the inverse correlation between the ES and sure, I'll show you tons of CHOP. It's easy to show CHOP because here's the thing. When the right line, remember that markets move in 3 patterns. They either trend, they either consolidate, or they chop. And we have a great indicator to define CHOP. I don't even have to show you an area of CHOP. I can show you where we won't trade. Every time the modified 15 here is yellow, for us, that defines CHOP. And we don't have any trades. Right here, this is CHOP. And we have no trades. Here's CHOP. And we have no trades. Now, potentially, the market can make some significant moves during a period of time when the modified 15 is yellow, but we tailored it for maximum stability. Because what we want to do is we want to trade with specificity and not sensitivity. We want to be on moves that have everything going for it, not be on a lot of moves, but be on a few moves that have everything set up in the appropriate direction. So CHOP is extremely easy to define. Now, anytime the 50 and the 15 are not moving in the same direction, not only are you in CHOP, but you're not trending. And remember, we only trade a trending market. So the only time that we have the go-ahead to trade is when the 50 and the 15 are to the downside, or the 50 and the 15 are to the upside. And it doesn't happen that often. This is a gigantic period of chop, and we don't trade that. Now here's a potential trade to the upside. Let's take a look at it. Now we don't have any background bias. So multiple time frames are telling us that the 13 and 21 range are not aligned in terms of market structure and price action, and there are areas of resistance to the upside that have not yet been broken. The 50 is yellow. It really doesn't have any trend at all. But the modified 15 is hard to the upside. So let's see what we have. We have the retracement and the pullback right to the modified 15. We take the trade right down to the quant indicator, and we have one quant line moving in our direction. Now the trade works, but I consider this to be a very, very aggressive trade, and it's not one that I would recommend to take. I want to see background bias optimally. I want to see the 50 green, and I would like to get both lines. I'm sorry, we have yellow and we have red. This is a trade I would never take to the upside. Now, as much as the indicators give you a validation of a true positive move, they're not going to catch every move. And if you want to take risky trades like this, they may work. But this is a super risky trade that I would not take because it's not validated by quant analysis and you're not trend trading. But then when we move over here at a chop, here's where we get the validation. Now, we don't take longs below the 50. We can't trade that. Here the 50's down and the 15's up. We have to wait. And now the tough thing about trading with specificity is that sometimes big market moves are going to go past us that we can't trade. But that you have to give that up if you want to trade with a lot of winners and filter out as many losers as you can. And as I always say, and I've repeated here, it's not about the number of winners. It's always about the number of losers. Now, I can show you real quickly here. I'll move to that in 1 second. This is a trade, another terrific trade on the ES that we got. The pullback right here, take it down. Both quant lines are green. The 50's green, the 15's green, and up you go. Now this could be a day-making trade. Depending upon your ATM and the number of contracts you trade, you're in one tick above the close of the candle, and you're not going to get the whole move. But the whole move is 6.75 points. You only have to wait for this kind of alignment to occur once a day, and you're going to make $3 or $4 or $5 or $600 depending upon the size of the lot and depending upon the aggressiveness of your ATM strategy. This is the kind of trade that we're looking to get. Now let's add some more stuff in. Because everything that we add in increases the predictive value of our trading entries. And I'm going to add in another indicator. And this is a quick one to describe for you. What this is, I have to go to the right edge to show you, is it's a volume analysis. I'm sorry, and I have to just show the price markers on it. And what this does is the line above shows you the number of contracts crossing per minute. The number behind shows you the average number of contracts crossed going back 15 bars. And what's important is you want to trade with significant volume. You don't want to trade in a dead market. And remember, there are only 4 pieces of data that any chart can show you. And people are going to twist it and turn it in all different ways. And sometimes they're going to show you what they proffer to you as being very novel indicators. But it all boils down to this. There's only the open, the close, the high, the low, and volume. That's it. There's no more data. And that is whether you trade Renko, whether you trade time or tick, the high of the bar, the low of the bar, the open, the close, and volume are all the information that's provided on any trading chart. Now, how that's twisted and turned can create novel indicators, but everything's dealing with those same 4 or 5 set of parameters. There is nothing else on the trading chart to show you. There is no magic. It's all based on these 5 values. Now I want to show you the 3-line indicator we have. Again, another fractal indicator. Right down here. Now it's at the bottom of the chart. And I think at this point, what I'm going to do is I'm going to take this down. I'm going to close this. I'm going to move this chart over. Just hold on one sec. I will reshoot the screen in a second if I have to. And I'm going to show you our full chart on crude. Is that seen okay? Okay. So let's take a look at our trading on crude. Now, we don't have a quant line on crude yet, but we're working on it. And these are what we're looking for. Periods in the market, and let's take a period where we're actually trading, not the middle of the night. Right here, where we get a move to the downside, we get a retracement, and then we get a continuation trade to the downside. Now, what these 3 lines tell us is the first line represents momentum. And essentially momentum is, in this particular case, we define it as a MACD. And this is assessing momentum on multiple time frames. When the first line is red, it means momentum is down on a multi-time frame basis. When the second line is red, it means that order flow is down on a multi-time frame basis. And order flow is an important component and a really interesting way to display volume because it's really a matter of supply and demand. And when order flow is red and the market is heading down, it means that there's more supply than there is demand. And price, because of that, is falling. People are selling. They're not buying, which is creating an excess amount of supply. And when there's an excess amount of supply, the price cheapens. So people offer the price of crude at lower, and it gets bid down. Now the third line is stochastic, and we have learned after doing really going back well over a year that stochastic does nothing to increase the predictive value of a trade. So even though the 3 line is here, the third line, we don't analyze it. We don't use it. But what we do is we project the data onto the price bar. Now, intra-candle, you can see that this candle is outlined in yellow. That tells you that order flow and momentum are with you on the trade, and that you should be in 1 tick below the close of the candle. and you're going to go a nice distance. Now, it takes a long time for a trade like that to set up again. Now, this is a little bit riskier, the move down, because the 50 is heading up. We don't really like that. Here's another trade. A little more aggressive. You can take it. Just understanding that you may be assuming a bit more risk. What makes this trade acceptable and this trade a little more dangerous is that on this trade, background bias has turned to the darkest color of pink. And that dark pink color tells you that market structure, price action are to the downside on the 13 and the 21 range, and that the 50 and the 15 are heading down on the higher time frames. So even though the 50 hasn't rolled yet on the 8, you've got the 50 down on the 13 and the 21. That makes this a nice trade to the downside. This lighter color pink is giving a little less strong of a signal to you, and I don't want to confuse you by telling you what this means, but this is the most powerful color. This is a great short if everything else aligns. But with the 50 heading up, this is a much more aggressive short. And you see, it doesn't go very far. The market retraces right back to resistance quickly and then continues down for a relatively nice move. If you let this signal pass and wait for the market to roll and wait for background color to turn, that's where you get your nice trade. Now, this one wouldn't have stopped you out, obviously, and might even gotten you a first target. If your first target's 5 ticks, you got it, and you're out of the trade. This one, though, is really the juicier trade, because this one gives you 11 ticks. And on a probability basis, this one is, you would imagine is more likely to be successful. Now, these are the kind of setups we look for, and like I said, they don't occur that often. Now, the other parameter that we look for is the distance, and let me put that indicator in. Now, everything that we do quantifies risk. And what we do is, this indicator can only be seen on the right edge of the chart. But what it does is, it shows you the distance that the candle is off the modified 15. Now, we want to trade directly off support and resistance. We don't want to trade 5 or 6 or 7 ticks off support or resistance, because if we do, there's a chance the trade will retrace right back into support. Now, this is how we did today in the live trading room. We had 5 trades. We had 4 winners and 1 loser. We had 10 ticks on gold, 10 ticks on crude, 5 ticks on the ES, 10 ticks on the ES, and I had 1 6-tick loser on crude oil. That was a perfect trade that just didn't go. And not every trade wins. But on a very, very ultra-conservative ATM strategy, we made $380 today in the live trading room. The auto trader took 1 trade and 1 winner and made $300. And I'll just quickly show you, I'll show you gold. If you wait, you're going to get wonderful trades. And here is the trade we took yesterday in the trading room. And it ended our day. And it almost personifies everything I'm talking about. We got a channel and consolidation right into the support of the 15. The 15 is green, the 50 is green. Candle is outlined in blue. It shows that order flow and momentum are with you on the trade. And we got a trade that went 44 ticks. Now, we had 1 small winner before that. That was the end of our day. That was just about a $500 trade, and we were finished trading. We had 2 trades, and we had 2 winners on Monday. And this is with everything aligning and everything that I'm telling you to look for. This consolidation indicator rings a bell for, I have it as an audible alert, which tells me when consolidation is formed and prints. It takes 4 candles to print consolidation. You're going to see it flicker on the 4th. When the 4th candle prints in the channel, you get a bell. And then I saw that 5th candle come right off of support, and up we went for 44 ticks. And we can do this on and on and on and on. Now, there are 2 other things that I just want to alert you to. Here's a really, really nice trade. A move to the upside, a retracement. Whoops, got the wrong button pressed here. The retracement, the move up, it's a C candle. We've got appropriate color background bias, order flow and momentum is with the trade. Up we go. If we just wait for alignment. Now I want to move back to the ES because I want to show you a little bit more on the quant indicator. Because we're going to be moving that onto other markets. And I'm going to bring that up from my trading chart, not from I want to show you the trading from today. Now these are the things that most people don't show you. I mean, they show you 100,000 slides, and they don't show you the actual charts they use to trade in a live trading scenario. There's nothing harder than being on the right edge of a chart. Anything else before that is just very, very simple. And let me bring up my ES chart here. And this is the chart that I use to trade the ES in the trading room. And let's take a look at it today. Now here's one of the, let's start it from the beginning. I think I had 3 trades on the ES, but maybe I only had 2. Here was the first trade that I took. It was a move up. It was a retracement. Now I did not have background bias, which concerned me a lot. But the reason I took it was that the quant indicator, both lines were green. So I knew that I had 5 markets confirming the direction of the ES on my trading chart. And it took me up 5 ticks or 1.25. Now I assumed additional risk here, because there was upside resistance that had not been broken, and I knew that price action, market structure were. I'm going to go into the room and I'll answer all the questions, so don't worry about that. And I knew that price action, market structure were not aligning, but I felt that 5 markets aligning with order flow and momentum on multi-time frames and trading right off of support was enough to push the ES in my direction, at least to a first target, and it was. I mean, I knew what I was doing in terms of taking on risk. I realized this was a little bit of a riskier trade. I knew what was going for me on the trade. I knew it was going against me. The platform defined that for me, and that's all any piece of software can do for you. It can define the risk associated with taking a long trade, which is why you never trade systems that give you blue dot longs and red dot shorts, but don't in any way try to quantify risk for you, because not every blue dot is the same or every red dot the same. Some come with increased risk and some come with less. Here the defined risk is very clear. Now here's an entry that I missed that I wanted basically to cry over. It was a move down. It was retracement right back to resistance. I didn't have order flow, but my quant was red. And my background bias told me that I had no resistance to the downside. Price action and market structure were heading to the downside on all my higher time frames. And I missed the entry. But I waited for it to retrace, came back, and took this trade and got 10 ticks. And this trade was a little weaker. I had only my lower quant line. My upper quant line was neutral. But I was trading with background bias. If you look down, I had order flow in my direction. Momentum was orange. There was enough on this trade. I felt like it wasn't going to be a loser. It was going to get me at least to my first target. And down it went, 10 ticks. After that, we were done in the room. We had the 4 winners, and I had already taken on that 1 loss. So there was nothing else to trade. But in essence, this defines the core of our system. It's built on multi-time frame analysis of market structure and price action, and it's built on the quantitative analysis of multiple correlative markets. And when you combine all of that with the fact that you only want to take very safe retracement trades in a defined trend. Now, there are other trades we take that are a little riskier. We take breaks of the 50 and breaks of the 15. So here's another great trade. So move to the downside, a move up, and look at this retracement trade. Both quant lines are red. You're trading with order flow and momentum. This is a great background color, confirming price action and market structure to the downside on both on your higher time frames. You've got order flow and momentum with you on the time frame you're trading. All of this shows up intra-bar. Set your entry 1 tick below the close of the candle, and you're in. The 5 range on the ES is just based on average true range. You get much less movement on it on the S&P 500 than you do on gold and crude. And also remember that you get more money per tick. And the reason you do is because you get less movement. If you get a 10 to 12 tick move on the ES, you get 3 or 4 points. I mean, that's a fabulous move. If you get a 15 or 20 tick move on the on crude or gold, they're not that uncommon. So what we do is we set the trading chart speed based on the average true range of the trading of the market that we're trading. When we start trading bonds, we're going to trade those on a 3 range, but we're going to have a quant line, we're going to have order flow and momentum, volume, and the multi-time frame analysis of price action and market structure, and it's going to look almost exactly like the ES chart. And we're not going to take a trade on bonds unless all the other markets that are supposed to move in the same direction or in a counter-trend direction give us a green-green or a red-red. We're not going to take a trade unless we have order flow and momentum. We're not going to take a trade unless multi-time frame analysis shows that market structure and price action are all going in the direction we want them to be. With all that, you don't get that many trade setups, but it's not about getting a lot of trades. It's about getting a very, very large number of winners and getting rid of the losers, sidestepping the losers. And there are a lot of setups. I want to find a setup that normally, here's a setup. Now, you have to remember that there was no pivot here. Here's a move to the upside. Here's a retracement back to the modified 15. You have order flow and momentum on the trade. Background bias is green. But if you go down and look at the quant analysis, you've got your correlative markets flat. And your anticipation is that even though price action and market structure are set up perfectly for a long trade, if your correlated markets are not moving with you, the trade's likely to fail. And that's exactly what happens. the whole trade collapses. And if you took a more modest trade here, again, which is a very modest retracement, right into the modified 15 here. And this trade actually would have given you a first target. And it does have a one quant line in your direction, and you're going to get 3 ticks. Our first target here is 3. But it's barely going to make it. It should go further, but it doesn't. I mean, this really isn't over here, this is really not a bad trade. Let me just bring this down here and see what we got. Yeah, we got one line green. And this is a trade you can take that does give you a first target. But it holds up this trade, and that's a loser. So what you want to do is you want to stack the deck and get as many things on your side as possible. Take a look at this trade. This is a break of the 50. And what we look for is a break of the 50 and a retest of the 50, and then a continuation trade to the downside. Remember, we're trend trading. We want the 50 down. We want the 15 to be down. We have order flow and momentum. We have a quant line red. We take the trade and down we go. So if I've given you a flavor for trading today, I hope so, because I don't think that you can trade with less than this. I'll give you another trade, and I know it might be getting redundant, but there's the move up. Here's the retracement. You're right back to the modified 15. Price action, momentum and order flow are with you on the trade. Take the candle down. Both quant lines are with you, green, green. And these are where the trades fly. 5 markets are moving in the direction that you want, and you're taking a trade right off support with order flow and momentum, and multi-time frame analysis tells you that price action and market structure are in your direction, and all resistance to the upside is broken. And that goes 12 ticks, 3 points. Those are the kind of trades you want to take. Everything aligns, everything is perfect, and you're going to get 2 or 3 of these trades a day, and that's all you need. Now, the price you pay is you're going to have to let some lesser trades go, but you know what? Who cares? If you want to get into every move, like I said, you're going to wind up sucking in a lot of losers. You just want to trade with an enormous amount of specificity. And these are the components I believe you need. You need 3 major components. One is you must trend trade. And the trend must not only be defined on your trading chart, but it must be defined by multi-time frame analysis. If you want to look at multiple charts, you can. If you want to trade right line, it projects that data onto your trading chart. Number 2, your indicators have to analyze data from multiple time frames. Trading with momentum on your trading chart is good. If you want to see the direction of the MACD on 2 higher time frames, you can do that. But if you want all that data projected onto your trading chart, our system does it. Trading with order flow is very important because that's a supply and demand issue. When you trade with order flow on multiple time frames, because all these are multi-time frame analysis components of our system, that shows up all on your trading chart. You don't need to have 2 other charts lined up. And you can trade minute bars, you can trade tick charts if you want. You know, you can trade a 3-minute, a 9-minute, and a 27-minute. Usually they're 3 times higher. You can trade a 1, 3, and a 9-minute. If you want to look at all those charts, you can assess that same data without having a fractal indicator. It's just a lot easier to do it. And then the third component I believe that you need now is you need quantitative analysis of multiple correlative markets. They almost guarantee you that the markets that correlate with the direction of the market that you're trading, when they're moving in the same direction as you, They're all united, and there's a group of overlapping stocks, and there's rotational markets where people pull money out of bonds and notes to put into the E-mini S&P. When all those correlate, the positive predictive value of your trading entry is astoundingly high. I think each component, as you peel it away, makes the predictive value of your trade weaker and weaker and weaker. So are there any other questions that I can answer at all? Let me just go to this slide really quickly. It's just a little information about us. Can that be seen, Leo? Okay, we see it all, but it doesn't matter. Now, one of the philosophies of our company is we never ask you to pay for boot camps. We give seminars and we give lectures. They're always free to the people in our company, to members of our community. We just created the quant indicator. That's okay. It's not showing a whole lot. I appreciate you telling me that, though. We just created the quant indicators. We give those out as a free upgrade for people who are part of our service. We don't come out with a 2.0 version and then charge you more money. These are all as we develop more indicators and try to create a more powerful system, we always give these out. When we created background bias, which took us a long time to create, to analyze market structure and price action on multiple time frames, we just handed it out. We're never going to ask you to pay more money for any of these upgrades. Now, as part of this, we're going to offer a special, a lifetime membership to the software. We also have our own trading platform, which adds on to the Ninja Dome and makes it a lot more powerful. And actually, we're very closely associated with NinjaTrader on this dome. And this is a patent-pending dome we have, which will really help you execute your trades. 2 hours of personal mentorship with me and 6 months in the trading room for $29.99. And we always offer a free trial to our trading room. Leo, would you put the link in for the free trial? Leo's going to put the link in for the free trial. We welcome everyone to come in. So far this week, we have 6 winners and a loser. We're up over $800. We're looking to have a $2,000 week in the live trading room. And we want you to come in and see how we trade, how we leverage the multi-time frame analysis that we do, when we leverage those quant lines to give us really, really very safe trades. And I took one trade today with all of that stuff on it, and it failed. So there's no guarantee, but if the analysis of the markets provides you out of 7 trades with 6 winners and 1 loser, you're going to make really, really nice money. It's the best you can do. Info@rightlinetrading.com is our email address, and here's our phone number. Now on www.rightlinetrading.com, there's a link there for our daily net equity in the trading room. There's a link there for our daily net equity on our auto traders. There's a link there for the sign up for a free trial if you don't have that link. And there's also a link for a contact us page. We're always here. We're very accessible. Leo's very accessible. We do all of the setups for you, all of the upgrades for you. We configure the system for you. We're really, really here to give you really, really excellent technical support. And I'm in the room every morning trading the system. So I'm not hiding. I don't sell you the software, then go hide under a rock behind the website with no phone number. We're right out there. So I just want to thank everybody for coming into the room, and hope that everybody will come into the room for a free trial and just see how well we trade. And if there are no other questions, I will just say wish everyone a really peaceful good night. And thank you, Kevin, and look forward to seeing everyone in the training room. Thank you guys very